Hello there. Welcome to another informative video on investments that will make your money grow. If you're sitting on any amount of money and it's scratching an itch in your pocket, consider investing it rather than spending it on something frivolous. But the question that then beckons us is, can you really make money quickly by investing that money? The answer is yes, you can make it, and this video is highly recommended for you. For many people, the word investing conjures up images of men in suits monitoring the exchange of millions of dollars on a stock ticker. I'm here to tell you, you don't need to be the Wolf of Wall Street to start investing. It's okay if you're more of a mouse of Main Street. Even if you only have a few dollars to spare, your money will grow with compound interest. To enjoy a comfortable future, investing is essential for most people. Unfortunately, in any crisis situation like the coronavirus pandemic has demonstrated, a seemingly stable economy can be quickly turned on its head, leaving those who haven't prepared to scramble for income. But those who could hold on to their investments may have done quite well. Investing can provide you with another source of income, fund your retirement, or even get you out of a financial jam. Above all, investing grows you wealth, helping you meet your financial goals and increasing your purchasing power over time. Or maybe you've recently sold your home or come into some money. Then it's a wise decision to let that money work for you. There are various types of investments or asset classes that you can choose from, each with distinct characteristics, risks, and benefits. Once you're familiar with the different types of assets, you can begin to think about piecing together a mix that would fit your circumstances. Number 1. Mutual funds. A mutual fund is a type of professionally managed investment that pools your money with other investors. The fund's managers then use the pooled money to buy securities of the group. It's best to start out investing in mutual funds or exchange-traded funds rather than individual stocks and bonds until you get your feet wet. These type of funds enable you to invest in a broad portfolio of stocks and bonds in one transaction rather than trading them all yourself. They're not only safer investments because they're diversified, but it's often far less expensive to invest this way. This is because you'll either pay just one trading commission or nothing at all in the event you buy a mutual fund directly from the fund company, instead of paying trading commissions to buy dozens or more different stocks. Although funds can be purchased through a brokerage account, you'll save money on trade commissions by buying funds directly through a mutual fund company like E-Trade or You Invest. Number 2. Fixed deposit. Fixed deposit is a great way to grow your savings with utmost safety. It is one of the most preferred avenues that enable you to deposit a lump sum amount with your financer and choose a tenor as per your convenience. On completion of your pre-decided tenor, your deposit starts earning interest through the chosen duration as per the interest rate at which you locked in your deposit. Once your investment amount has been locked in at a specific interest rate, it remains unaffected by further changes in interest rates or market fluctuations. Thus, you can get guaranteed returns on your deposit, and you can choose to get your interest periodically or at maturity. Usually, the defining criteria for fixed deposit are that the money cannot be withdrawn before maturity, but you may withdraw them after paying the penalty. Number 3. Real estate. Traditional real estate investing involves buying a property and selling it later for a profit, or owning property and collecting rent as a form of fixed income. But there are several other, far more hands-off ways to invest in real estate. One common way is through real estate investment trusts, or REITs. These are companies with income-generating properties. Think malls, hotels, offices, etc., and offer regular dividend payments. Real estate crowdfunding platforms, which often pool investors' money to invest in real estate projects, have also risen in popularity in recent years. Investors who already have healthy investment portfolios and real estate investments are highly illiquid, so investors shouldn't invest any money they may need to access quickly. Number 4. Stock market. The most common and arguably most beneficial place for investors to put their money into the stock market. When you buy a stock, you will own a small portion of the company you bought. When the company profits, they may pay you a portion of those profits in dividends based on how many shares of stock you own. When the company's value grows over time, so does the price of the shares you own, meaning that you can sell them at a later date for a profit. Index investing is another way of investing in the stock market. Instead of buying a stock in an individual company, you purchase stock in a stock market index, which tracks the number of the largest companies in the stock market. Number 5. Bonds. Whether it's corporate, municipal, or treasury, bonds are a great way to leverage your investment against the success of other entities. Bonds are debt security that raises capital for others. They finance new companies, local projects, and even the US government. While no investment is risk-free, government bonds, T-bonds, are just about as close as you can get. You might also want to consider investing in worthy bonds. Worthy bonds are $10 each and offer a fixed rate of 5% return. Each bond has a 36-month term, and interest is paid weekly. Cash in the bond anytime you'd like, even before maturity, and you'll never pay the penalty. The money you invest in Worthy bonds is used to fund worldwide, and Worthy is very picky about which business to lend to, who liquidate assets far exceed the loan amount, making the risk low for a terrific 5% return. Number 6. Gold. Yes, you can invest in gold and other commodities such as silver or crude oil. In fact, the practice of investing in gold goes way back, but that doesn't necessarily mean it's a great investment. Gold is a commodity, so its price is based on scarcity and fear, which political actions or environmental changes can impact. If you are investing in gold, be aware that your protection against a price drop, your moat, is based on external factors, so the price can fluctuate a lot and quickly. For example, the price tends to go up when scarcity and fear are abundant, and down when gold is widely available and fear is diminished. If you think the world will be a more fearful place in the future, then gold could be a good investment for you. Number 7. CDs and bank products. Certificate of deposit, or CDs, and bank products are issued by banks and generally offer a higher interest rate than savings accounts. These federally insured time deposits have specific maturity dates that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specific period of time without penalty. With a CD, the financial institution pays you interest at regular intervals. Once it matures, you get your original principal back, plus any accrued interest. So it pays to shop around online for the best rates. Because of their safety and higher payouts, CDs can be a choice for retirees who don't need immediate income and can lock up their money for a little bit. But there are many kinds of CDs to fit your needs, and you can still take advantage of the higher rates on CDs. Number 8. Cryptocurrency. Cryptocurrencies are on the rise. While trading them might seem risky, if you hedge your bets here as well, you could limit some fallout from a poorly timed trade. There are plenty of platforms for trading cryptocurrencies as well, but before you dive in, educate yourself. Find courses on platforms like Udemy, Kajabi, or Teachable, and learn the intricacies of trading things like Bitcoin, Ether, Litecoin, and others. While there are over 3,000 cryptocurrencies in existence, only a handful really matter today. Find an exchange, research the trading patterns, look for breakouts of long-term moving averages, and get busy trading. You can use exchanges like Coinbase, Kraken, or CEX.io, along with many others to make the actual trades. Corporations sometimes raise money by issuing bonds to investors, and these can be packaged into bond funds that own bonds issued by potentially hundreds of corporations. Short-term bonds have an average maturity of 1 to 5 years, making them less susceptible to interest rate fluctuations than immediate or long-term bonds. Corporate bonds can be an excellent choice for investors looking for cash flow, such as retirees or those who want to reduce their overall portfolio risk but still earn a return. Number 9. Commodities. Commodities are physical products that you can invest in. However, they are common in futures markets, where producers and commercial buyers, in other words, professionals, seek to hedge their financial stake in the commodities. Therefore, retail investors should make sure they thoroughly understand futures before investing in them, partly because commodity investing runs the risk that the price of the commodity will move sharply and abruptly in either direction due to sudden events. For instance, political actions can significantly change the value of something like oil, while the weather can impact the value of agricultural products. Number 10. Annuities. Many people use annuities as a part of their retirement savings plan. When you buy an annuity, you purchase an insurance policy, and in return, you get periodic payments. Annuities come in numerous varieties. They can last until death or only for a predetermined period. They may require periodic premium payments or just one upfront payment. They may be linked partially to the stock market or an insurance policy with no direct link to the markets. Payments may be immediate or deferred to a specified date. Finally, they may be fixed or variable. While annuities are pretty low risk, they aren't high growth. As a result, they make an excellent supplement to retirement savings rather than a vital funding source. This video will help you choose the best option for investment that will make your money grow. Now, if you have any amount of money to play with, you can start to invest. Thank you so much for watching my video. Please stay connected with us to get more informative videos.